In Money Watch, it was a good day for investors with all three markets rebounding to start off the week on Wall Street. The markets rallied out of the gate and never looked back. The Dow finished the day in positive territory, ending up 641 points.
The S&P 500 finished the afternoon up almost 2.5%. The tech-heavy NASDAQ also had gains, finishing the day up over just 2.5%.
Joining us now for more on this is Brett Ryan. He's a senior U.S. economist at Deutsche Bank. Hi, Brett. Great to see you. So what drove the market up so high today?
Yeah, great. Thank you for having me on the program. It was more a little bit of a rebound on lack of news, if you will, after an eventful week with Chair Powell and the Fed last week. It was coming after a long holiday weekend, and I think when the stock market sold off about 18%, the S&P 500 over the last 90 days.
Right.
So it took a little bit of a breather here, and interest rates were up a little bit today, but not anywhere near the large moves that we've seen over the past several weeks.
Yeah, as you mentioned, the markets their rebound followed last week's sell-off, which erased nearly $2 trillion from the S&P. Tell us why investors are coming out of the gate so strong. You mentioned the long holiday weekend. What else do you attribute this to?
Yeah, like I said, I think it's more of a relief rally where there could be a little bit of flow going through, but I think volumes in general are down versus the averages, especially after last week. So I wouldn't say it's a strong move or indicative of a larger rebound in the market just yet. Mm-hmm. You have to keep in mind that over the past 90 days, you've had the 10-year interest rate rise 150 basis points. The 2-year interest rate has risen 210 basis points. Those are the largest increases since 1984. And that's really because of the inflation outlook has changed dramatically relative to just 3 months ago, certainly from the Fed's perspective and from most economists' perspective. So we expect the Federal Reserve to be hiking rates to eventually to 3.6% by the end of this year, 4.1% by Q1 of next year. And that's going to put downward pressure on the economy. And I think that Chair Powell and company, they've started to acknowledge that this is going to be more of a bumpier landing, and the Fed is going to have to risk recession.
Yeah, interest rates of over 4%. So let's talk about that because we are hearing growing concerns about a possible recession from some economists, although not all. And President Biden does say it certainly is not inevitable. So in your view, what needs to be done to make sure that that's true, that we don't hit a recession? And do today's gains play into that narrative at all?
No, I don't think today's gains play into that narrative. And unfortunately, our call has been for a few months now, since April, that the economy will enter a mild recession next year. So, the timing is always difficult to kind of put a handle on. But the fact is that you have goods spending that is extremely elevated relative to the pre-COVID trend. Services spending is still under the pre-COVID trend, but that transition from goods to services spending is enough in itself to slow down the economy. Add to that the fact that the Fed is going to have to be very restrictive because inflation remains high. And so real rates, after inflation, have to be more around a percentage point. We haven't seen that in quite some time, and neither is the stock market. The stock market hasn't seen real rates this high in quite some time, and that's why you're seeing the discontent on the part of investors.
A mild recession you're still predicting. What about stagflation? Just real quick, Brett, do you think that any of the things that the Fed is doing to try and tamp down inflation is having a positive effect? Well,
I think the Fed has said, and Chair Powell will reiterate this week with his Humphrey Hawkins testimony to Congress. The Fed's commitment to bring down inflation is unconditional, and that means they'll do whatever it takes to bring down inflation, even if it is causing recession. So from that perspective, they have a lot of history of mistakes that the previous Federal Reserve's committees had made to bring us to a stagflationary environment. And so I doubt they're going to make those same mistakes that maybe Fed committees from the 1970s made. We're in a different operating environment now. At the same time, you have other central banks across the globe. The ECB is lifting off soon and moving up rates. And so you have a global move on the part of central banks to bring inflation, tamp down inflation under control. The unfortunate side effect is it's going to slow growth, and it's going to make it very difficult to sort of, engender that soft landing that, Fed officials had hoped for.
Yeah, we're still hoping for it.
Yeah, such a tricky balancing act, right?
Ryan,
All
thank
right.
you.